We are the best, we're unstoppable, and then what happens? Some curveball comes into our lives and it throws us off. And that's where the markets are right now. They're in extreme greed, where we're at a point where the investing public thinks nothing can go wrong, and ultimately that's exactly historically, and this is going to historical analysis now, that's exactly where things go wrong.
In the world of investing, overconfidence can lead to complacency. However, history has shown that unexpected events can disrupt even the most optimistic outlook. Currently, the market is fueled by extreme greed, with investors believing that nothing can go wrong. But historically, this is when things tend to go wrong. Recent developments in the cryptocurrency landscape, including the SEC's lawsuits against Binance and Coinbase, have caused a swift downturn in the crypto markets. The fragile U.S. economy also faces the looming threat of a commercial real estate market crash, with significant commercial mortgage debt maturing by 2025. Concerns arise regarding the U.S. government's need to sell trillions of dollars in bonds to refinance its debt, potentially leading to higher interest rates. Analyst Gareth shares a bearish stance on cryptocurrencies and predicts a potential stock market crash. He highlights the challenges the Federal Reserve faces in managing interest rates and the risks associated with high inflation. The SEC's crackdown on crypto exchanges raises questions about the future regulation of cryptocurrencies and their impact on the market. The transcript emphasizes the current risks and uncertainties in the investment landscape, underscoring the importance of caution and informed decision-making.
And the problem is that what we know is the Fed continues to probably raise rates later this year. Yes, they will likely pause next week, but they also have, so the government, and check this out, this is not being talked about yet. In the next 3 months, the government will have to sell $1 to $1.5 trillion in bonds to the world. All right, now you ask yourself this, number one, what interest rate are they going to have to do? Essentially, this is debt that's going to be rolling over, that they have to essentially refinance. So you're taking debt that was probably at a 1% to 2% interest rate. You're now looking at selling it to the public or to the world at around a 5% interest rate. So think about the U.S. deficit and what that's going to do to the U.S. deficit. By the way, there's a reason why when they passed the debt ceiling, there's no cap on it right now. For the next 1.5 to 2 years, no cap whatsoever, because you have all these factors here going on where they have to unload a ton more debt to keep the merry-go-round going. So now you're talking about how much is going to be sold to the world, and then what interest rate is that going to be at? And again, is that a headwind? Well, I would think so. Then you take it into account, and I had a great Spaces last night, verified Spaces, by the way, every Tuesday night at 7 p.m. We had an amazing group of experts on last night. We were talking about the commercial real estate market and what a massive, massive collapse that could be. So ultimately, that's coming later this year. We know the banks are already stressed. We know banks have failed already. Now you throw into the mix the commercial real estate crash. Now you go back to the Fed saying, hey, listen, we're going to have a mild recession. And I said this before when they said this. As soon as they say mild, I get scared. I get scared because every time they say something, it's never what they say. It's always worse. You could go back to 2007. Oh, it'll be, a minor correction. Real estate will correct. That's fine. Well, look at what happened. The Great Recession. We had massive downside in the markets, collapses every which way. You go back to transitory inflation. What did that turn out to be? So everything they do, there's always this miscalculation. Whether it's hopium on their part or not, it's miscalculated. So you have to say to yourself, all right, if we are going to continue to see this economic data, now jobs have been staying strong. That's the one positive in this overall picture. But the other side of it is the other economic data is absolutely weakening. So again, when all is said and done, you look at the second half of this year, I have it priced in, number one, by the end of the third quarter to fourth quarter, we will be in a recession. The stock market by the third quarter, which we're getting close to, right, will be putting into an effect essentially where we're going to be, the stock market will start to price that in. All right, all it's going to take, especially with the VIX at these levels. In fact, let's go back to the charts. I want to show you this VIX. All right, we're going to look at this. All right, so if we go to the CBOE Volatility Index, the VIX is trading at 14. All right, basically touched 13 this morning. If you go back in time, we are still at the same levels on the VIX that we were in 2021. Now, to me, this is a negative divergence. And you say, well, why is this a negative divergence? And the answer is this, and think about this, right? The negative divergence is that people are acting like this is a new bull market, but we're not at all-time highs. So last time the VIX was at 14, we were at all-time highs, crypto was at all-time highs, the stock market was at all-time highs. Now we're basically at those same levels on the VIX, but the markets are lower. Again, that's a negative divergence. So that has me concerned as well. It's essentially people being as euphoric as they were at all-time highs, but we're not at all-time highs. Essentially, people are getting conned into this belief by the psychology of the market.
During the credit crunch, banks significantly raised their lending standards, making it difficult for businesses or households to get loans. Borrowers may have to agree to more stringent terms like high interest rates as banks try to reduce the financial risk on their end. Banks were already tightening lending standards before the crisis within the industry began. A quarterly survey of loan officers published by the Fed showed that a growing number of banks tightened lending standards and saw a sharp slowdown in demand. Even before the collapse of Silicon Valley Bank and Signature Bank in early March, the commercial real estate market was struggling with a number of challenges, including higher interest rates and waning demand for office space as more companies allow employees to work from home. As we get back into the video, Gareth makes a bold prediction for Bitcoin's next price and also talks about the SEC's recent suing of crypto giants Binance and Coinbase.
And so you have all these people talking about deflation. That's not going to happen. And I'm going to tell you why. It's not going to happen because the reason people are making more money is because the general wage got raised. We know people that were making $12 went to $25 per hour. All right, that is going to be sticky. You can't start reducing people's wages. Once you set them at $25 an hour, you can't bring that down. That's going to keep inflation sticky north of 3%. With it north of 3%, ask yourself this: when the heck is the Fed going to cut rates? How can they cut rates? And you might say, well, oh, they could cut rates, no big deal. Well, if you're at 1.5% and you raise and inflation jumps to 9%, now if you start at 3, where is inflation going to top out? 15%? How are we going to feel about that? I don't think the Fed wants to do that. They're going to be very reluctant to lower interest rates. Now, right now, markets, are they pricing in anything like this? And the answer is absolutely not. All right, so those are a couple things. Now, I want to get to Bitcoin, right? I want to talk a little bit about Bitcoin here. Bitcoin having a beautiful reversal yesterday. So essentially, you have to understand the metrics going on. 2 days ago, the SEC sued Binance, and they levied some really serious accusations. If these accusations are true, that's cataclysmic for the crypto markets. Now, what I find fascinating here is you essentially have a market that yesterday rebounded and negated that move. Now, to me, this is an interesting dynamic. And I'll tell you the dynamic that honestly makes me intrigued, is that you have a crypto investing public that essentially is saying, no, we don't believe. The SEC has lost credibility to the point that when they say that Binance was doing shady things with funds, we're not going to believe them. Because if this was true and Binance ultimately collapses, the detriment to the crypto markets would be massive.